Assalamu alaikum friends, welcome to the 7th part of IFRS 9, and in this part we are going to discuss the derecognition of financial instruments. And this part is not so long. So financial instruments includes everything: financial asset, financial liability. Okay, how do we derecognize and when do we derecognize them? That's what we are going to go through in this video. So conceptual framework, we always have to refer to the conceptual framework whether it comes to recognition or derecognition. Okay, so according to the conceptual framework, the derecognition normally occurs when the entity loses the control of the asset. That time you derecognize the asset, or has no present obligation for the liability. You derecognize the liability. So for asset, it means you are losing control, and for the liability, no present obligation. Okay. Accounting for derecognition should faithfully represent the changes in an entity's net assets as well as any assets or liabilities retained. This is achieved by, so you are derecognizing if you are transferring, okay, derecognizing any transferred or expired or consumed component. Okay, if any component has been transferred or expired or consumed, it is derecognized. Okay, and once you are derecognizing it, you will be having a gain or a loss, right? So you have to recognize that gain or loss on derecognition, and you have to recognize any retained component. If you are not selling it entirely, just a part of a component, the part which is retained, you have to recognize it. So there are 3 steps that you need to follow when derecognition comes. First, derecognize whatever is transferred, expired, or consumed. Second, because of that derecognition, recognize profit or loss. And third, retained component you have to recognize. Okay. Sometimes an entity might appear to have transferred an asset or a liability, right? But still, the derecognition is not appropriate. Why? Because the exposure to variations in the element's economic benefit. That means even if they have given the asset or the liability, the cash flow, the economic benefit, the cash that they have to receive or that they have to pay, they are still retaining it. They're still receiving the cash, or they have to pay the cash, the economic benefit, right? So if they are getting it, if that is retained, then you still cannot derecognize even if you have transferred an asset or a liability. Okay. As you will see below, IFRS 9 is consistent with conceptual framework. You need to remember this so that it becomes easy for you to write in the exam if they ask you whether IFRS 9 financial instrument is consistent with the conceptual framework, the recognition and derecognition of an asset or a liability. With regard to issue of derecognition, they are consistent. So now we are going through each element: financial asset, financial liability. These are the 2 elements. Financial asset, how this should be recognized? This should be derecognized if one of the following has occurred. Either this or that. First one, contractual rights have expired. What does it mean? That means you no longer you have the right to receive cash. Okay, for example, an option held by the entity has lapsed and become worthless. If you're having an option that it will be exercised, okay, but it's not exercised and it becomes worthless, that means you're not receiving any cash from that option anymore. You don't have the contractual right, it has expired. So option becoming expired and becoming worthless. Okay, it's a very good example. That means your contractual rights have expired. Next, financial asset has been sold. You are either selling it, and substantially all the risk and reverse of ownership have been transferred from the seller to the buyer. Not just the asset, the risk and the reward of that asset also you are selling to the buyer. Okay, so both has to be sold. You have to see whether it's just the asset that has been sold or also the risk and the rewards. All 3 things has to be sold to the buyer. What are the 3 things? One is the asset, the financial asset, the other one is the risk, the other one is the reward. Then financial asset is derecognized. It's very easy. The analysis of where the risk and rewards of ownership lies after a transaction is critical. It's sometimes difficult. It's not clear cut. Who is having the risk of and the rewards of the ownership of that asset after the transaction? That means after selling. If an entity has retained substantially all of the risk and rewards of a financial asset, then it should not be derecognized. Please remember this. Even if it has been legally sold to another entity. Okay, if the risk and the rewards of having that financial asset is still with you, you cannot derecognize, even if the asset you have sold. Coming to the financial liability. This you should derecognize when obligation is discharged. No more obligation is there, right? Or it is cancelled, or it expires. So these are the accounting treatment of derecognition when it comes to financial liability. The difference between the carrying amount of the asset or a liability. Okay, this is generally they are talking about the accounting treatment of both financial asset and financial liability. Okay, it's not relating to financial liability only, because they told here the difference between the carrying amount of the asset or a liability and the amount received or paid for it should be recognized in profit or loss for the period. Definitely, when you are selling at that date, you see what is the carrying amount of your asset or a liability and at what amount you are selling it for. So definitely if you are selling it for more than your carrying amount of asset, it's a profit. So you need to recognize that profit or loss. Okay, we have already discussed it, that profit or loss needs to be recognized. Next, for investments in equity instruments. So there are two things. One is, if it's equity instruments, then how do you derecognize? When it's debt instruments, how do you derecognize? Remember, these are also financial instruments only, but we had separately learned them. Okay, equity instruments, debt instruments. So for investments in equity instruments held at fair value through OCI. Okay, remember, equity instruments held at fair value through other comprehensive income. The cumulative gain and losses. We are not talking the amortized and all. Okay, we are talking about the fair value through OCI. The equity instruments can be measured two ways. One is amortized cost, one is fair value through OCI. Unless you elect. Okay. So the cumulative gain and losses recognized on OCI not reclassified to profit or loss on disposal. That means whatever the gain or losses are there, you cannot, they are not reclassified. You cannot reclassify it when you're disposing the equity instruments. It will be forever in the OCI only. If it is for investments in debt instruments held at fair value through OCI, same. This is also through other comprehensive income only. So don't go and write fair value through profit and loss for derecognition. They have not said anywhere. The cumulative gain on losses recognized in other comprehensive income, this time they can be reclassified to profit and loss and disposal. So can you see, if it is equity instruments, not reclassified. If it is debt instruments, reclassified on disposal. Okay, disposal means you are disposing that debt instruments. At that time, you can reclassify to profit and loss. So that's it for derecognition of financial instruments. We are over with it. Now we'll be doing test understanding. Before we officially move on to the next topic will be derivatives and embedded derivatives, another very important area, and you can be asked question from that area as well. I have been asked a question on embedded derivatives for 5 marks. I still remember it was my question number 3. I will never forget that, because I was so prepared for IFRS 9. I was expecting a question on IFRS 9, a tougher one in fact, but embedded derivative, the question was easy. It was quite easy. It was worth 5 marks. Yeah, so definitely you can expect a question in most, not derivatives, but yeah, embedded derivatives for your, if IFRS 9 comes up. So now let's start with test your understanding. Test your understanding 13. Ming has 2 receivables that it has factored to a bank in return for immediate cash proceeds. Okay, what does this mean? What does the first sentence mean? The first sentence means your receivable is factored to a bank. Now bank is supposed to collect the receivable for you on your behalf. You'll be getting the receivable amount from the from your receivables and will pay it to you. Okay, so now what are you doing? But in return for immediate cash proceed, you are receiving some cash proceed, right? That means you have to give them some cash. For that, some commission you have to give to the bank. So you are using factoring. Okay, I'm sure that you know what is factoring. Both receivables are due from long-standing customers who expected to pay in full and on time. Ming had agreed on a 3-month credit period with both customers. The first receivable is for 200,000. In return for assigning the receivable, Ming has received 180,000 from the factor. Okay, so out of 200, 180 they have received. Next, under the terms of the factoring arrangement, Ming will not have to repay this money, even if the customer does not settle the debt. The factoring arrangement is said to be without recourse, okay? One is known as with recourse, the other one is without recourse. Without recourse means you don't have to repay the money if the customer does not settle the debt. Okay? The second receivable is for 100,000. In return for signing the receivable, he has received 70,000 only from 100 from the bank. The factor is the bank, right? The terms of this factoring arrangement state that Ming will receive a further 5,000 if the customer settles the account on time. If the customer does not settle the account in accordance with the agreed terms, then the receivable will be resigned back to Ming. Okay, to Ming, who will then be obliged to refund the factor with the original 70,000 you have to give to the bank. This factoring arrangement is said to be with recourse. Discuss the accounting treatment of the two factoring arrangements. Right? It's possible that you can collect your receivable amount from the bank through a factor rather than you directly collecting it, because they are specialized in that, right? That's possible. So the principle at stake with the derecognition or otherwise of receivable is whether we are talking about the derecognition now of receivable, whether under the factoring arrangement the risk and the rewards of ownership pass from Ming to factor or not. We have to see this. Who is having the risk and the rewards of the ownership of the receivable? So the key risk with regard to receivable is the risk of the bad debt, isn't it? That they will not pay. Your customers might not pay. This is a risk of bad debt. In the first arrangement, the 180,000 has been received as a one-off non-refundable sum. This is factoring without recourse for bad debts. So the risk of bad debt has clearly, so in this case, because you don't have to refund it to the bank, that means the factor. Okay, so the risk of bad debt here, it's passed from Ming to the factoring bank. That means from Ming you should derecognize that receivable. So Ming should derecognize the receivable and there will be an expense of 20,000 recognized. Remember, an income or an expense will be recognized based on that derecognition of receivable. It's an expense. Okay. Next, what about the second arrangement? The 70,000 which is received. It is simply a payment on account and more simply a payment on account because later you'll be receiving more payment if customers pay on time. So more may be received, right? Later more will be received. It was 5,000 will be received or something by Ming, implying that Ming. So in this case, that means Ming is the one who is retaining the element of reward. He will be having that reward in the future, right? So the money received are refundable in the event of default and as such represent obligation towards the bank. They have to refund it. This means the risk of slow payment and the bad debt remains with Ming, who is liable to repay the money so far received. So despite the passage of legal title, the receivable should remain recognized. In this case, receivable is recognized in the accounts of Ming. So in substance, Ming has borrowed 70,000 and this loan should be recognized immediately. How do you recognize it? In substance means it's like you are borrowing 70,000, okay? And this loan should be recognized immediately. Okay, this will increase the gearing of Ming. Next, case holds equity investments at fair value through profit or loss due to short-term cash flow shortages. Okay, case sold some equity investments. Now he is selling some equity investments for 5 million when carrying amount was 4 million. The terms of disposal state that case has the right to repurchase shares at any point over the next 2 years. They can repurchase it over the next 2 years at their fair value on the repurchase date. Case has not derecognized the investment because his directors believe the repurchase is highly likely. Now you need to advise the directors of case as to the acceptability of the above accounting treatment. Is it acceptable to derecognize or is it not acceptable to derecognize? You need to now advise. How will you advise? To advise, you should know the rules of derecognition when an equity investment is sold. or it can be repurchased in the future. What are the derecognition rules? We have just went through the derecognition rules when it's equity investments. Okay. So an entity has transferred a financial asset, right? It has transferred the contractual. Why? How can you say it has transferred a financial asset when they're talking about equity instruments? This is a very good question. You should ask this type of questions. It means that your mind is working. You are in the topic. You are deeply interested in the topic. That's why you're asking this question. Usually people don't ask such questions. But if you're asking these questions, that why here we are talking about equity investments and suddenly we went to the financial asset. How is that? See, derecognition comes when your financial asset or financial liability, it is transferred, or if it's a financial asset, if it's transferred. If it's a financial liability, the obligation, whether there's an obligation or not. Okay. So here they are selling it. Okay. Here's not about obligations or not. It's an equity investments. Okay. So that means it's about transferring a financial asset. That means an entity has transferred a financial asset if it has transferred, because if it has transferred the contractual rights to receive the cash flow of the asset, it is referred to as financial asset only. So you have to see, what are you transferring? Are you receiving the cash? Do you still have the right to receive the cash, or are you selling that right to someone else to receive the cash flow from the asset? If you are transferring it, you are transferring financial asset. Okay. Because early what happens, you will be receiving the cash flows from having these equity investments, right? Now if you are selling these equity investments, you are selling what? The contractual right to receive the cash. Someone else will be receiving the cash now. Okay. That's why we're talking about financial asset here. So IFRS 9 says that if an entity has transferred a financial asset, what should you do? You should see which, up to how many portion it is retained, and how much of the portion has been transferred. So you need to evaluate the extent to which it has retained the significant risk and rewards of the ownership. If the entity transfers substantially means a big amount of risk and rewards of ownership has been transferred, they must derecognize the financial asset. Okay. And also the gain and losses you have to recognize from that disposal. Now let us go to this one. Case is under no obligation to buy back the shares. Do they have an obligation? No. And is therefore protected from future share price decline. Even if in the future decline, they don't have to buy it back because they don't have the obligation. So if case does repurchase the share, this will be at what? Fair value rather than a prefixed price. And therefore, case does not retain the risk and rewards relating to the price fluctuation. So whatever happens to the price of the share price, case is not having the risk and the reward of that. Why? Because it does not have the obligation to buy back the shares. So even if the price reduces, okay, so he's protected from the share price decline. That's why. If he's protected from the share price decline means there is no risk, right? He's protected from the risk from the price fluctuations. So the risk and the rewards of ownership has been transferred. Okay, that means case is not having the risk and rewards anymore. That means that is transferred. Okay, so that means case should derecognize the financial asset because risk and rewards are transferred. Fair value is 4 and it has been sold for 5, so there's a profit of 1 million, and this will be recognizing profit or loss. Okay, and the last test you're understanding 15. Just I think 14 is over. Okay, 15. Jones bought an investment in equity shares for 40 million plus associated transaction cost of 1 million. Asset was designated upon initial recognition at fair value through OCI. At the reporting date, the fair value of financial asset had risen to 60 million. Shortly after the reporting date, financial asset was sold for 70. A. How should the investment be accounted for? B. How the answer would be different if the investment had been classified to be measured at fair value through profit and loss. You should know this when the classification changes from 1 to 1. So first let us answer A. Okay, definitely this is a bit lengthier answer. So when you are purchasing the investment, it will be at fair value only. Always at fair value. That's why the asset is classified as fair value through OCI, because they told, what did they tell? That they have designated upon the initial recognition that it will be fair value through OCI. So that's why it will be classified as fair value through OCI only. And transaction costs are included in the initial value. Okay. What is it? 41. Why? Because you are adding 40 and 1. The transaction cost you are adding with the 40 million. So 41 debit asset and credit cash. Next, at the reporting date, this asset is remeasured to fair value. Okay. They have told that it has increased to 60. So because it has an increase, there's a gain of 19, and this will be recognized in OCI and taken to equity. So debit asset, because asset will go up, and credit OCI. It's a gain. Next, before the disposal, asset is remeasured to fair value with the gain of 10 million. How? Because you have sold it for 70 and that time your fair value was 60. So this is the gain, and this will be recorded in OCI because you have designated to be under OCI. So here also debit asset, credit OCI. Now the asset is then derecognized. Remember, when you are selling it, you have to derecognize again. At what amount? At the amount that you are selling, 70. So cash you are receiving 70 and credit asset by 70. Okay. Next. Whatever the gain or losses, remember that you are writing in OCI, they will never be reclassified to profit or loss. Okay. Next. Because you have because you told that it will be designated through OCI. So for that you cannot reclassify it to the profit and loss. But in the second one, things are different. They told it will be through profit and loss. So here, transaction cost will be expense if it's through profit and loss. Okay, so now you don't add that one with 40. You debit asset 40, you credit cash 40. Instead, that 1 million you are putting in the profit and loss account in the debit, and you are cash credit 1 because as a transaction cost you have to pay in cash. So credit cash. Now it will be the asset is remeasured to fair value. So it's a gain of 20 million because from 40 it has increased to 60. And this will be recorded in profit and loss this time, not OCI. So you debit asset, you credit profit and loss. On disposal, you have to derecognize. Okay. So how much? You are selling it for 70. So you are receiving cash, debit cash 70. Asset, you are selling it for 60, the fair value. And credit, because it's a profit of 10 million. You need to credit it. Okay. So that's it for derecognition of financial instruments. Next, we'll see you with derivatives and embedded derivatives. Till then, take care.